The IRS has just released the new 2026 tax brackets, and if you're retired or approaching retirement, this update could impact how much of your income you actually keep. The changes may look small at first, but for seniors collecting Social Security, taking retirement withdrawals, or living on fixed income, they could make a real difference. So before you assume nothing has changed, stay with me, because one of these new numbers could affect your tax bill more than you think. Today, I'm going to walk you through exactly what changed for 2026, show you where the hidden traps are hiding, and by the end of this video, you'll know precisely what to check before you make another withdrawal decision this year. So stick with me till the end, because the last section covers something most retirees never even think to look at, and it could be the most expensive mistake on this entire list. Now, here's a myth I want to clear up right away. A lot of people believe that once you retire, your taxes automatically go down. And for some retirees, sure, that's true. But for a growing number of seniors, the opposite happens, especially once you start blending Social Security, pension income, and withdrawals from retirement accounts. You spend your whole working life contributing to IRAs and 401 kiloseconds, and then retirement arrives, and suddenly you realize multiple parts of the system are looking at your income at the same time. The IRS looks at your taxable income. The Social Security Administration looks at something called your provisional income. And if you're on Medicare, there's a separate calculation looking at your modified adjusted gross income too. These systems don't operate in isolation, they interact with each other. And that's exactly why a single withdrawal decision can quietly ripple through your entire financial picture. Here's where this gets important. For 2026, the IRS kept the same 7 tax rates: 10%, 12%, 22%, 24%, 32%, 35%, and 37%. So the rates themselves didn't move. What did move is the income thresholds for each bracket, adjusted upward for inflation. Think of your income like layers in a cake. Each layer gets taxed at its own rate, and only the portion of your income sitting inside a higher layer gets taxed at that higher rate. This is called your marginal tax rate, and it's one of the most misunderstood concepts in the entire tax code. Moving into a higher bracket does not mean your whole income suddenly gets taxed more. It only means the new dollars above that line get taxed at the new rate. Now, this is the part many retirees overlook. For 2026, the standard deduction increased to $16,100 for single filers, $32,200 for married couples filing jointly, and $24,150 for heads of household. That's a few $100s higher than last year across the board. But if you're 65 or older, there's an additional standard deduction on top of that, $2,050 if you're single, and $1,650 per spouse if you're married. And here's the headline everyone's talking about right now: a new temporary senior bonus deduction of up to $6,000 per person, on top of everything else, whether you itemize or take the standard deduction. Let's do the math together, so this actually makes sense. If you're single, 65 or older, and your income is under the phase-out threshold, you could be looking at your $16,100 standard deduction, plus $2,050 for your age, plus $6,000 for the new bonus, which adds up to roughly $24,150, shielded from taxation before brackets even come into play. If you're married and both spouses are 65 or older, you're potentially stacking $32,200, plus $3,300 in age deductions, plus $12,000 in bonus deductions, somewhere around $47,500 total. On paper, that looks like a huge win, and for a lot of retirees, it genuinely is. But there's another detail you need to know. That bonus deduction comes with an income catch. For single filers, it starts phasing out once your modified adjusted gross income crosses $75,000 and disappears completely around $175,000. For married couples, the The phase-out starts at $150,000 and disappears around $250,000. So if your income is hovering anywhere near those numbers, a withdrawal that seems small on its own could quietly cost you part of that deduction, on top of the tax you owe on the withdrawal itself. And this is exactly why this update matters more than most people realize. In retirement planning, phase-outs can actually hurt more than tax brackets do, because when you cross one of these thresholds, you're not just paying tax on the extra income, you're simultaneously losing a benefit you were counting on. That combination can create what feels like a much higher effective tax rate than the bracket number would suggest. To retirees with nearly identical income can end up with very different tax bills, purely based on how and when they pulled money out. Let's walk through a simple, real-world example. Say you're a retired single filer, and between Social Security and a small pension, you're already sitting around $40,000 in taxable income for the year. You decide to pull $15,000 from your traditional IRA to cover a home repair. That withdrawal doesn't sit in its own little box. It lands right on top of your existing income. Part of it might still get taxed at 12%, and once you cross the threshold, the rest spills into the 22% layer. Now imagine that same withdrawal happens to push your total income just over that $75,000 mark we talked about. Suddenly you're not just paying a slightly higher rate on part of that withdrawal. You might also be shrinking your bonus deduction at the exact same time. That's the domino effect retirees need to watch for in 2026. Now let's talk about something that catches almost every retiree off guard at some point, and that's Social Security taxation. Most people assume their Social Security benefits are simply tax-free. That is not always true. Depending on your combined income, meaning your other income plus half of your Social Security benefit, up to 85% of your benefits can become taxable. The new senior bonus deduction helps offset this for a lot of people, but don't mistake it for a complete fix. The thresholds that determine how much of your Social Security gets taxed have not been adjusted for inflation the way regular tax brackets have, which means more retirees creep into taxable territory over time, even without a real increase in their standard of living. Your IRA withdrawals, your pension income, and even interest and dividends all factor into that calculation. Here's another detail that rarely gets mentioned, but it matters just as much. If you're on Medicare, your premiums aren't based on this year's income, they're based on your tax return from 2 years ago. That means what you withdraw or earn in 2026 could quietly affect what you pay from Medicare in 2028. If you take a larger withdrawal this year, sell an investment, or convert money to a Roth account, and it pushes your income over certain thresholds, you could see a surcharge added to your monthly Medicare premium 2 years down the road, sometimes without ever realizing why. This is one of those hidden traps that almost never gets connected back to a decision made years earlier. And it's exactly why timing matters so much in retirement. Now, here's a common mistake I see all the time, and it's worth repeating clearly. People assume all retirement income gets taxed the same way. It doesn't. Withdrawals from a traditional IRA or 401,000 are treated as ordinary income, taxed according to those bracket layers we just walked through. Withdrawals from a Roth IRA typically tax-free, since you already paid tax on that money before it went in, and qualified Roth withdrawals generally don't count toward the income calculations used for Social Security taxation or Medicare thresholds either. That's a big deal. A traditional IRA withdrawal can ripple through taxes, Social Security taxation, and future Medicare premiums all at once, while a Roth withdrawal, in many cases, doesn't touch any of those calculations. This is exactly why more retirees are looking at Roth conversions during lower income years, not necessarily to avoid taxes altogether, but to build flexibility for later. If you're finding this useful, do me a favor and hit subscribe now, because this channel breaks down exactly this kind of retirement tax planning every single week, and you don't want to miss the next video where I go even deeper into strategies most retirees never hear about from their tax preparer. Now let's talk about something that doesn't get discussed nearly enough. What happens to your taxes when a spouse passes away? This is sometimes called the widow's tax penalty, and it deserves far more attention than it gets. When one spouse passes away, the household often loses one social security check, but most of the household expenses stay exactly the same. On top of that, the surviving spouse eventually shifts from filing jointly to filing as a single taxpayer, which means every one of those bracket thresholds we discussed earlier gets cut roughly in half. Income that used to sit comfortably in a lower bracket can suddenly land in a higher one, purely because of a change in filing status, not because income actually increased. This is exactly why planning ahead, while both spouses are still here, can make such a meaningful difference for whoever is left behind. There's also a window of opportunity that a lot of retirees walk right past without noticing. The years between when you stop working and when required minimum distributions begin can be some of the most valuable years for tax planning in your entire retirement. Your earned income has stopped, Social Security may not have started yet, and your required withdrawals haven't kicked in, which can create a temporary lower income window. Some retirees use these years for strategic Roth conversions, moving money from a traditional account into a Roth account while their income, and therefore their tax rate, is lower than it might be later. Once required minimum distributions begin, that window closes, and the flexibility goes with it. If you're in this stage of retirement right now, this is genuinely the time to be thinking this through, not 5 years from now. So here's your practical takeaway, and I want you to actually use this. First, figure out exactly where your income is coming from this year: Social Security, pension, any part-time work, and planned withdrawals, and add it all up. Second, compare the total against the thresholds we covered today, the bracket lines, the senior deduction phase-out ranges, and the Social Security taxation thresholds. Third, ask yourself if you're taking full advantage of every deduction available to you, including this new senior bonus deduction. And fourth, think about whether you have enough flexibility between traditional accounts, Roth accounts, and regular savings, because flexibility is what lets you control your income instead of your income controlling your tax bill. Here's the bottom line: the 2026 changes aren't dramatic on their own, but they interact with each other in ways that catch a lot of retirees by surprise. A single withdrawal can touch your tax bracket, your senior deduction, your Social Security taxation, and your Medicare premiums 2 years from now, all from one decision made today. Understanding how these pieces connect puts you in a much stronger position than most retirees are in right now, and it's exactly why a little bit of planning ahead of time is worth so much more than scrambling after the fact. If this video helped clear things up, hit that like button. It genuinely helps this channel reach more retirees who need to see this before tax season sneaks up on them. Subscribe if you want more straightforward breakdowns like this one. No jargon, no scare tactics, just what actually matters for your money. And drop a comment letting me know which part surprised you the most: the senior deduction, the Social Security taxation, or the Medicare look back. I read every comment and it helps me decide what to cover next. And if you want to understand exactly how Social Security taxation is calculated behind the scenes, click the video on your screen right now, because most retirees have never actually seen that formula, and it explains why so many end up paying more than they expected. Thanks for watching, and I'll see you in the next one.